What's up guys, welcome back to the channel. This is still me, Solomon Wisdom, aka Born to Trade, and in today's video we'll be talking about internal and external range liquidity. Internal and external range liquidity is a simple concept, but most smart money traders still find it hard to understand. So in today's video I'll explain how to identify internal and external range liquidity and how you can trade them. That is how you can make money from the financial market by just understanding internal and external range liquidity. Okay, before I start explaining, if you're totally new to this channel, consider subscribing to this channel. Here is Born to Trade, and if you have interest in joining my Telegram channel, you can check the description box. The link is in there. Okay, now internal and external range liquidity. Before you can understand internal and external range liquidity, you need to have the understanding of how to map out your market structure. Okay, let's say in a situation you have something like this. You have something like this, and mapping out your market structure, you know that here is your higher high and here is your higher low. This low right here puts in this high. Okay, so when you see something like this, everything at the external side, everything outside here, this is your external range liquidity, and everything that is outside the range, because between here and here is your trading range, everything outside here is your external range liquidity, and everything in here is your internal range liquidity. Okay, I hope you understand it. And let's say price is in a downtrend, and this is equally the same thing. This is your range, this is your trading range. Everything outside this range is your external liquidity, and everything inside this range is your internal liquidity. And I hope you understand better before the end of this video. Okay, so I'll be explaining this with this sketch on the screen right now. So what can we see from here? What we can clearly see is that price is in an uptrend. Here was your higher low. Price broke structure to the upside. Price prints a higher high. Okay, after the higher high, what do you see? We start seeing a retracement, which is a pullback, or you call it a correction. Okay, so during the pullback, what can you see? What you can see, price starts to print an internal structure, and what you need to understand from here is that this is your sell side liquidity. This is the external side liquidity right here, your sell side liquidity, the external side, and this is your buy side liquidity, that is the external range liquidity. Everything outside here is external. Okay, now what can you see at the internal parts? You can see price pulls back, and you can see it broke structure to the downside here, and this is the internal range liquidity, that is the internal sell side liquidity. SSL means internal sell side liquidity. Okay, you see it's a pullback and a drop down. Price was taking internal sell side liquidity. After a pullback, another drop down, price was just taking internal sell side liquidity, and over here you can see price mitigates another block. Price mitigates it and change direction over here, and now price is taking the internal buy side liquidity, because what you understand right here is that liquidity rests below highs and lows. Okay, so you see these lows right here, liquidity was resting at these lows, and what you can see is that price was taking the liquidity at the lows. Now that price has changed direction, it starts to take the liquidity at these highs. Okay, so this is your internal buy side liquidity. I hope you understand it. Now, why is understanding internal and external range liquidity, why is it important to understand this? What you need to understand about internal and external range liquidity is that it provides liquidity for POIs. Yes, this provides liquidity for your point of interest. If you watch the video I made about high probability setup, I said something about that being one of my favorite setups, because when price builds liquidity above or below your zone, you understand that that's a high probability setup. Now let's say you have your point of interest right here. You have your point of interest and price builds this liquidity. You already understand that this makes this point of interest a high probability point of interest, because there is a reason for price to reverse. When price mitigates this zone, there's a reason for price to reverse and starts targeting this internal buy side liquidity. Okay, so this is one of the importance of internal range liquidity, because it provides liquidity for POIs. It makes point of interest a high probability one. Secondly, you can use this buy side liquidity for intraday or scalping targets. Okay, so if you take intraday trades, understand when price was pulling back, price was coming to this higher time frame point of interest right here. So if you are taking trades, against the trend and you got your entry at this POI, you can take your targets at these levels. Okay, maybe you're taking trades from these zones. Here could be your targets. You could be targeting these lows because liquidity rests below those lows. Okay, so let's say in this case, taking trades here, you can be targeting these highs and these highs because liquidity rests above those highs. Okay, that's the second need of understanding this concept. But one thing you need to understand is that taking trades against the trend isn't really nice. It's risky and it's hard to catch those kind of trades. So what I would like you to focus on is catching the move with the trend, because this retracement, most times you don't know when the retracement is going to end. So the best thing to do is to catch the trades that aligns with the overall trend. Another thing you need to understand is that the zones at the extreme liquidity side is usually the strongest, because if you measure with your FIB tool, you see that this zone is at the discount level, so they are usually the strongest, and trading from that zone you can target the buy side liquidity. Why is the buy side liquidity your target? Because that high fails to take out this particular low, and this makes this high a very weak high and makes this low a very strong low. Let me just show you something quickly on the price charts. Let me show you quickly. So looking at this price chart right now, this is a high right here and price pushed to print this low. After price prints the low, what you can see is that price moves and it breaks this high. Okay, I'm gonna map it out as a break of structure. This is a break of structure. So when price do something like this, what you need to do is to mark out the highest point and the lowest point, because that is your trading range. This is your trading range. Looking at this, you understand that this is just one leg of price. This is the range, and marking this out, you already understand that this is your external range liquidity, this is your buy side liquidity, and this is your sell side liquidity, because liquidity rests below highs and lows. Everything resting inside this range is the internal range liquidity, and you can go ahead and start marking it out. Internal sell side liquidity. Now there was a pullback, price pulled back, mitigate something at this high, it drops down, take out this liquidity. Internal range liquidity, your sell side liquidity, price was taking them out, mitigates this low, and it's change direction right here. Hope you can see it. Price change direction and it starts to take the buy side liquidity at these highs. Price starts to take out the liquidity resting at these highs before it moved and take out this major liquidity, which is the buy side liquidity at the external range. Okay, so like I was explaining, like this internal structure provides liquidity for POIs. Okay, so from here you can see this is a liquidity pool that will be targeted when we get our entry. You can see price can target that liquidity because now price starts into the zone, clearing the liquidity below the lows. Now when price starts to move, these highs will be targeted, and you can see this buy side liquidity at the external side can equally be the target. So like I said, secondly, you can use it for your intraday and scalping target. So if you're a scalper, let's say you're a scalper and you were able to take a trade from here after the chalk. Let's say you were able to take a trade here, could be your target. Okay, let's say maybe you got another entry right here, here can equally be your target. Or when price reversed and you were taking trades from here, you can target these highs, it could be your target. So these are simple concepts like I've always said, and I said POI at the extreme are usually the strongest, and you can see price came back to mitigate POI below here. It's not really clear right here. Maybe when you go to a higher time frame, you can able to get the correct POI and you can then refine down to your lower time frame. Okay, so POI at the extreme are usually the strongest, and remember I said trading the pullback can be a little bit risky because in some cases price might not get to the extreme POI, it can react off another POI. That's it, and I hope you got value from this video. I hope you learned one or two things. I know I didn't go deep into explaining more, but I hope with the little things I've explained today, you were able to catch one or two things. At least you understand that when you map out your range, liquidity resting outside of the range is your external range liquidity, and every other lows and highs inside the range is your internal range liquidity.